Alright, there are two phases of retirement, the saving and then the spending after you've saved for so many years. The main part of saving in retirement is the cost. Well, first you have to worry about a few things, like the cost for living, debt, college spending for your kids, and even if you save a lot, there's still inflation, which takes away some of your savings, so it's less to spend. A lot of the sources for retirement can be investments, like your personal investments, stocks, mutual funds, bonds, or also your 401ks, 403bs, and 457s. Also, you can get some saving from rental properties, and Social Security is a great, also a little smaller form, but it's still great because, and also the longer you wait for it, the more you'll actually get monthly. So it could be beneficial in the long run if you live really long. Also, continued employment checks or like payment from your employer could also help you save for retirement, and then spending, that's the easy part.
So there's such thing as tax-deferred investments. Financial planners recommend that one of the best ways to save for your retirement is contributing to a tax-deferred investment. Tax-deferred investing allows you to keep money that would have been paid in taxes at the time you earn the money, leaving a greater amount available for investing. A tax-deferred investment is when you don't pay any taxes on the money you invest until you withdraw it in retirement. However, there are penalties for withdrawing early, before the age of 59. All tax-deferred accounts carry a penalty when you withdraw. Currently, there are 6 different tax rates in the United States. As a result of tax-deferred investing, you can have the same amount of money in your pocket and invest what you would have paid to the government. There are 3 types of retirement plans: employer-sponsored plans, also known as pension plans, self-employed plans, called SEPs, and individual retirement accounts, as we know as IRAs. The plans differ in a couple ways. Depends on who is eligible to participate in the plan, the amount one can contribute to the plan, the type of investment available to the plan, and the tax consequences for early withdrawal. The first type of plan is the employer-sponsor plan, or the pension plan. Employees' money deposited into an account by the employer. There are several types of employer-sponsored plans. The 401k, which is a private corporation, 403b, schools and nonprofit organizations, and Section 457, state and local government employees. There's also the self-employed plans. There's several different options for this plan also. The KEO plan, the Simplified Employee Pension Plan, also known as SEP, and the Saving Incentive Match Plan for employees, also known as SIMPLE. For SIMPLE, you must employ fewer than 100 employees, and you can match up to 3% of your employee's contribution. For the third type of plan, the IRA, the Individual Retirement Account, this is a personal retirement savings plan. It can be set up with virtually any bank, mutual fund company, brokerage firm, or any similar investment organization. There are 2 types of traditional IRA categories. There's the tax-deductible and the non-deductible. For the tax-deductible, you take a tax deduction on your contribution each year. You don't get to reap the benefits to be taxed at a lower tax bracket in the future though. For the non-deductible, when your yearly income rises above $75,000 jointly, you would have to go this route.
One of the greatest ways to save for retirement is a Roth IRA. What's great about it is it can escape taxation. The money you contribute is already taxed via your paycheck, so the interest earned and principal withdrawn at age 59 and a half are tax exempt. Withdrawals of principal, for most reasons, can be made after an account has been established for about 5 years. You can contribute to a Roth as long as you are a worker or a spouse of a worker. Some of the pros of a Roth IRA are tax-free income upon withdrawal, no required withdrawals by a certain age, tax-deferred earnings, immediate tax savings on yearly contributions, interest earned taxed at time of withdrawal. Some of the few cons are you can't have there's no deductible against your yearly taxes. An account must be open for 5 years for tax-free provision to take effect. Required withdrawals beginning at 70.5 and tax due at regular rates upon withdrawal. So these are one of the greatest forms of retirement or retirement earnings because there's no taxes.
Okay, go. There's two things you can't avoid in life: death and taxes. The average person works to pay taxes. There are both federal and state taxes. Some states don't have income taxes, such as Alaska, Florida, Nevada, South Dakota, and Texas. There's 4 major tax categories. There's taxes on purchases, which include sales tax and excise tax. A sales tax is imposed every time you purchase any product. However, an excise tax is a tax imposed on specific goods, such as gasoline, cigarettes, alcohol, beverages, and air travel. The second type of tax is the tax on property. There's school taxes and property taxes. The third type of tax is a tax on wealth. An example of this could be the estate tax or the death tax or the inheritance tax. All mean the same thing. The federal estate tax exemption has been set at $5 million. So this means up to that amount there's no federal estate tax for a single person. However, there's the tax exemption for married couples is at $10 million. If there is a trust, now this is important. This is critical that you need to know this. If there is a legal trust document created prior to the death, there is no taxation at all, and everything passed tax-free, and everything passes tax-free to the beneficiaries named in the trust. Now this is a way to avoid the estate tax, and it's critical. If there is not a trust, remember this, if there is not a trust created by the descendant, then the heir is responsible for the amount of inheritance tax, as the value of the estate tax is considered a passive income. Now there's the gift tax. Anything above $3,000 given as a gift with no lifetime maximum as of 2010 is considered a gift tax. Now the fourth major category for taxes is the tax on earnings. There's the federal income tax, the state income tax, the Social Security income tax, and the Medicare tax. Now, the way your federal income tax is calculated is by step 1. You have to determine your gross income. The types of gross income can either be earned income or investment income, which is also called passive income. Earned income could be examples of earned income could be wages, salary, commission fees, tips, or bonuses. However, examples of investment could be dividends, interest, or rent from investment. The second, step 2, determine your adjustments allowed by law, also known as deductions. The standard deduction amount for 2011 for a single parent it was $5,800. For the head of the household, which I am in Pavan and I's relationship, is $8,500. That's on video. Is $8,500. The third step to do is you subtract your gross income from your adjustments, which equals your taxable income. The fourth step is determine your tax liability. The tax liability is calculated by using your taxable income amount and using the IRS listed tax tables for federal and state. Step 5 is determine tax credits allowed by law. Tax credits is when it comes to saving money on your tax return. Unlike tax deductions, tax credits are subtracted from the final amount of the taxes you owe. Step 6, you got to subtract the tax liability minus the tax credits, and this equals the total taxes due. Now, this is very complex, and this is why the government likes taking taxes.
Who needs an estate planning, you ask? The chances are you do. It isn't just for the wealthy, and without it, you don't control the assets when you die. An estate plan allows you to provide for your family even when you are no longer with them. It is also important that you plan for incapacity. It can happen to anyone anytime. So, be prepared. This may involve you getting a living will, which puts your wishes upon death in writing. A healthcare proxy, which allows you to designate someone to make healthcare decisions for you on your behalf. It's also very important that you get a trust, preferably a revocable trust, because this allows for a family member to manage your assets and doesn't make your assets subject to government stipulations. Without an estate plan, your property and assets are subject to state and federal intestate laws, which generally results in a loss of money. This also results in many problems and ignores your actual wishes. A will is a great way to direct your assets and money to the people or places you want them. A life insurance policy is also a very valuable tool that can provide for your loved ones. Again, use trust. It is arguably the best beneficial tool available. Here I'm going to talk about some helpful tips you can implement in your life that will make you better prepared for later on, and eventually a better life for your loved ones when you are no longer here or able to provide for them. Number 1, put everything in writing. It is important that all important information, including social security numbers, account information, and especially medical information, are written down in case you are impaired or unable to reach them yourself. Stay tuned. Tax information and policies are constantly changing, and it may be privy to your investment plans. Number 3, make it known. Let your children or other loved ones know your plan for once you die. This makes your last wishes come to fruition and avoids any guilt involved. Number 4, keep documents safe. Make sure someone else knows where all the vital documents are in case something happens to you. Number 5, costs. Make sure you know the cost of retirement and estate planning so you can prepare throughout your life in order to make for a peaceful and stressless retirement. And number 6, reminder, get a will, trust, and plan for your future. It is important.
After watching our videos, all our informational videos, you're probably wondering, where should you be? Well, if you're 35 years old, you should probably have 1.4% or 1.4 times your pay away. And at 45, you should have 3.7 times your pay. And at 55, you should have 7.1 times your pay. 12% to 15% salary per year should be also set away. This way, you can beat inflation by 4.5% per year. And that's all you need to know, where you should be.
And local government employees. There's also the KEO plan for. Yes. There's 2 things you can't avoid in life: death and taxes. Let's talk about taxes right now. The average person works to pay taxes during his life. There's both federal and state taxes. And so, 2 things in life you can't avoid: death and taxes. Taxes is something the government does. Start it over.
In your life that will make you better prepared for your later career life. Damn it.
When you put your money in, you can escape all taxation. But when you remove it, it could be the one disadvantage is it could be the tax bracket of you older, so it would be higher. All right, we're not gonna say that. All right, never mind. All right,
Okay.
I need to